if this recessionary fears looming in the US actually translate to a big recession, what happens to IT spends? We have the management of eClerx's joining us to understand the potential impact. So Girish, just stay on. Nadadhur Srinivasan, who is the CFO at eClerx's, joins us now to talk about that. Mr. Srinivasan, good morning and thanks for joining in. You know, in your own investor call, you had mentioned that recessionary fear, if a recession plays out, it could have an impact, a spillover effect on the industry and on companies like yours. What exactly could the impact be? Are you looking at, client spends reducing? Are you looking at lower orders? And what is the situation on the ground at the moment?
So, thank you for having me firstly. I think that if there is a recession in our client geographies, naturally as suppliers, we will not be immune to it. And both of what you said in terms of lower spends and lower orders will come into play. We are keeping a close eye on this. At the moment, we are discussing with clients on what potential impacts to their budgets could be. So we don't see an immediate impact, but definitely it's an area to watch out for. Maybe a couple of quarters down the line, there might be an impact. The impact for us, I think, as we have part of our book is discretionary spend, that might be impacted more than the non-discretionary keep the lights on kind of business.
Do you want to split that up for us, Mr. Srinivasan? If you could...
About 30% would be discretionary and 70% would be keep the lights on.
Keep the lights on. So this 30% could come under pressure, right?
That is right.
And in what way you think? If you can go back and tell us, what happened during, say, the period of slowdown that we saw before? Does the size of work itself come down? Do clients ask for better pricing from you?
I think pricing and the work size does not change. I think there is a delay in the spend itself. So sales cycles tend to become longer. And that's the primary impact that happens.
So it gets pushed out. It takes...
that's right.
Clients take longer to decide.
That's right.
And how long does this usually last? Are you already starting to see that, by the way?
We are not seeing it right now. And it may last between 12 to 18 months is what I think.
So your top 10 clients bring about 60% of the business to you right now. So there's still high amount of client concentration. In these top 10 clients, have you seen any slowdown in orders, delays in orders, etc.?
At the moment, no.
Okay, all right. Mr. Srinivasan, the company went into a bit of a lull for a few years, in that vicinity, I think around 2017 to 2020. Now, last year was a good year. You had a good bump up in terms of growth. Now, given the factors that are at play, what kind of a rough growth number will you look at? Double digits? Will it be high double digits? And also last year margins improved, but there were a couple of costs that weren't factored in. Though this year you have a tailwind with regard to the rupee. Putting all this together, the street is bracing, I think, for some bit of pullback in margins. Do you want to quantify that? And also on the growth number, give us a broad
on
band.
The growth number, I think when we went into FY23, the pipeline that we see is as strong as the pipeline that we saw last year, same time. However, do remember that the base is higher because last year was a blockbuster year. I think we grew by about 38% or so.
Yes.
So definitely in terms of percentage terms, the growth this year will be lower, but we still do expect it to be healthy. In terms of margins, we generally give a guidance of around 28 to 32% EBITDA. And despite the attrition pressures or despite the talent scarcity that we see, we think we will still be able to hold to these numbers.
But will you be drifting more towards the upper end or the lower end in terms of margins? And at least give us a broad band on the top line growth. I remember you all did some inorganic growth that as well as helped you all move closer to around that $250 million plus of revenues. Put it together, what kind of a rough number can you look at in terms of revenue growth?
So double digits for sure. Beyond that is the macro environment is a little uncertain at this point of time.
Okay.
So based on the pipeline that we can see, double-digit growth is definitely possible.
Okay.
On the margins, 28 to 32% EBITDA, we should be able to hold to that.
Okay, so hold on to 28 to 32% EBITDA and double-digit growth on the top line. What is the cash on the books currently?
680 crores.
Okay, so 680 crores cash on the books, and you've bought back a lot of shares in the past. So what do you plan to do with that money this year?
So I think we will take a call on returning cash back to shareholders. So that's been our traditional buyback has been our traditional form of returning cash back to shareholders. So unless there is any inorganic requirement for that cash, I think given when we are allowed to have a second buyback, I think we will prefer to return part of that cash back.
Are you all on the prowl though for inorganic growth?
So we are always looking for opportunities.
Could you tell us?
But these things
Yeah,
are difficult to predict.
What about the size of the acquisition? You know, you're going by the looks of it, you're giving us a hint that you're always on the prowl. I mean, if there's something attractive that comes up, what could be the size of the acquisition in case you're looking at one? And could we hear something, say, in the first half of this fiscal?
It's difficult to comment on when that news will come out. Typical size tends to be about 10 to 20% of our revenues.
Okay, all right. Just one quick point. In your business, was there a mad scramble for talent? I mean, did that push costs excessively high, as we saw with many other IT companies?
So in the discretionary part of the business that I talk about, which is the analytics and automation service line, where skill requirements are higher, definitely there is a shortage of talent. And we've had to pay up for getting good talent. On the non-discretionary part, which is largely operations driven, I think our training and knowledge management helps us to.
Got it. No, Mike, I'm just asking on the discretionary side, has things starting to soften a little bit on the on the wage front?
Yeah, we do see attrition ramping down and the pressures on hiring going down.
Okay, you're already starting to see that. That's interesting. Thank you very much, sir, for joining us. Great speaking with you. So maybe some sort of work gets pushed out because of this entire U.S. recession narrative, and that's natural, right? I mean, when there's uncertainty, you don't want to commit large amounts of work, not just IT, but elsewhere as well. And that push out could be, the postponement could be, as he said, 12 to 18 months, depending on, of course, the underlying situation there. But that's 30% of their business. 70% is keeping the lights on, as he described it. So that doesn't get affected.
It's so unfair, right? For many of these companies, we keep asking them what could the impact of the recession be, but no one knows. I mean, no one knows the extent, the severity, how hard landing could shape up. I mean, how is a company going to know whether client spends are going to reduce or not? But I guess
we should make a hard case for a soft landing.
All right, well, let's do one thing. Let's